when we are transferring to credit side, the next entry is going to be income summary account. That is, we are going to transfer all that in the debit side, credit side. That is the expense account. We already transferred to the credit side. The debit entry is going to be income summary account. That is the total. It's going to be in the income summary account.
Matilda, may I ask you a question?
Yeah.
Expenses in the balance are on debit side.
The total.
No.
Yeah. Normal balance is debit. Yeah.
When we closing, we change it to opposite side.
Yeah. When we are closing, I will show what is the reason we are closing. This is okay.
Because of we are closing the year, right? We should use the different account. Like if we are using annual debit, we should use the across like a credit. If we are using the credit, we should use the debit. Okay, I got it. Because they should be zero when finish the year, right?
Yeah.
Okay.
This is why we create income summary account, but why we have expenses on the debit side?
The expenses always in the debit side. That is the normal side, right?
Yes. Why you now put it?
I'm going to show you debit and a credit.
Oh, I got it. I got it actually.
Okay. Rent is $5,000. If you want to close the book, if you want to make zero, we have to bring it to credit side, right? That's what we are doing now. When we bring it to debit side, credit side, the difference between see, when we transfer to debit side, credit side, the difference between debit and the credit is going to be zero. That is the reason we are transferring to other side.
Okay.
If it is zero, next year we are going to start a new book, new ledger.
Oh, that's clear for me. Go back to the left, please. Why you put expenses on the credit side and income summary on debit side?
Because the journal, we have to have two sides, right? Debit and a credit. If you put all that in the credit side, we have to have debit somewhere else. That is income summary account. Income summary account is a very, very temporary account. Only once a year we are using to close the book. That one is because from income summary account, we are going to calculate our profit or loss. That's what we are transferring revenue in the credit side, expenses are in the debit side. Then the difference between those two is profit or loss.
But that's you just now you have expenses on credit side, not on debit.
No, all are in the credit side because we are transferring. This is the journal we are closing. This is not the real expense account. This is the journal for closing. The real one is always in the debit side, right?
Yes.
See, rent expense always in the debit side. When we are closing,
it is going to credit.
Yeah, this is the rent. This is debit side. The rent expense always, any expense always in the debit side. If you want to close it, closing means we are going to make zero. If you want to make zero, credit also has the same amount, right? That's what we are bringing this for credit side. When we are transferring to credit side, when we are writing a journal for credit side, we have to have somewhere else in the debit side. That's what we are bringing to income summary account, debit side. You understand that?
Well, I understand this very clear what you mean about income summary account, but I don't understand why you use income summary account for revenue and income summary account for
Expense.
expenses on the same side. In
No,
your
not the same side. See, this is the credit is revenue, debit is expenses. This is the balance in the ledger.
okay, go then to the left journal, to the journal.
Yeah.
You see the row number 8, income summary expenses, 73,000.
Yeah. That is the expenses. All the expenses.
Accounting, yeah.
Yeah. All the expenses total is this. This is the total of the, yeah.
I just remember this. Doesn't matter.
Okay.
You
Just
know,
we created just one line for everything,
Yeah.
right? We shouldn't
Instead of-
write detailedly.
Yeah.
We didn't write
All the expense
detailedly.
accounts.
Yes, yeah. Just all the expense account. Yeah.
It's going to be like this.
Mhm.
The same amount has to come in the debit side. Instead of listing all the accounts, we put the total for the income summary account.
Mm-hmm.
But in the real counting, in the manual accounting, they are listing all the accounts and put the amounts individually. But here I am showing on the total. Only the total is showing in the income summary account. Total of this. Are you are you okay, Kate?
Yes, thank you. Yes, I see it now in just opposite way. Yes.
Yeah. This is the income summary account. Our revenue is going to be in the credit side and expenses is going to the debit side. We are going to calculate profit or loss from the income summary account. After we transfer this one is going to be 70,000 minus 73,000. This one is 3,365. That is our loss because our revenue is less than expenses, right?
Mhm.
That is the way the, okay. You already did the first step. You close the revenue account. The second step, you close all the expense account. Now we are going to close the income summary account. That is the third step. You are going to close income summary account. In the income summary account, your credit balance, this is your credit balance 3,365, right? Debit balance. Income summary account, you have 3,365. If you want to close it, you are going to put in the credit side. That means you are going to put in the credit side. Then this minus this plus this is 0, right?
Yes.
If you put in the credit side, somewhere else you have to put in the debit side, that is the capital, because the loss is always decrease the capital, right?
Mhm.
Okay. In that case, this one is going to be, you're crediting to income summary account, debiting to capital account.
Mhm.
If it is profit, that one is going to be in the credit side because capital is increasing by profit, decreasing by loss.
Mhm.
Are you okay? That is the third step. Third step, you are going to close the income summary account. This income summary account is loss. That's what your capital is going to be debit. Income summary account is going to be credit.
Yeah.
Are you okay, Kate?
Yes, I follow you.
Okay. That is the third step.
Mhm.
That one is in the capital account. The balance is going to be 45,000 minus 3,365. Today the balance is this. You have another transaction about drawings. You have drawings $12,000 in the debit side, that is the fourth. When you are closing, you are going to put in the credit side. Then 12,000 minus 12,000 is 0. If you have credit side, you have to have somewhere else debit side. That one is going to be in the capital account, because capital is decreasing by drawings, right? 41,635 is the balance after profit or loss. Now we have drawings. Our new balance is going to be this.
Yes.
We started with 45,000. Our loss is 3,365. Decreased by that. And also the drawings 12,000. 41,000 minus 12,000 is going to be 29,000. This is the new capital for next year. We close all the temporary accounts, revenue, expenses. In the new year, we are going to have only balance sheet balances. The capital only is changing according to this. Other than that, according to your trial balance, you are going to take all the balance sheet items except capital. That is the new trial balance. New trial balance is going to be this. This is the new capital. These are the balances from the trial balance. All the balances are same. Only the capital is changing for next year. Next year, revenue account, expenses account, you are going to start from the beginning, start from 0. Every year you are closing. The reason is you are going to transfer your profit or loss to capital, and starting with the new balances the new year. Otherwise, if you don't close the books, you don't know your net worth of your business, right? That's why you are closing the book. And also there's a rule. Every fiscal period, we have to close the book according to the accounting rules. I think the same thing in your country too, right?
Yes, we are using the same system, yeah. In Turkey, we are using the same.
Yeah. Calculate the capital. After you finish, you have to calculate the capital. This is the capital. Then this capital you are going to bring to next year. That one is this.
Yeah, it will be start that, right?
Yeah, this is the capital you're starting with new year. Any questions?
No. Clear so far.
Everybody, we can go to the next lesson, right?
Yeah, okay, sure.
Next lesson is going to be page 51. That one is partnership. Want to read it? Partnership?
I can start reading.
Okay, sure.
Thank
Somebody
you.
will just follow me. A partnership. A partnership is a business that is carried on by two or more people who have combined their financial resources and expertise. Their decisions and actions would generally be made jointly, and each partner would share in the profits or losses recorded by the partnership. Partnership contract outlines the name and location and nature of the business, the names, duties, and rights of each partner within the scope of operation, Some partners might be granted the right to make all ongoing operating decisions, while other partners may be just financial backers, not taking direct day-to-day operations. The amount of capital to be invested by each partner. All partners may not have equal investment in the business. All the assets of the business are personally owned by the partners. The amount of cash each partner is allowed to withdraw from the partnership. Sorry, the amount of cash each partner is allowed to withdraw from the partnership. Partners are not paid a salary, but they can take money from the business through personal drawings. The partners can be held responsible for the actions and business debts of the other partners. A provision for insurance on the lives of partners with the surviving partners named as the beneficiaries. The annual audit by a public auditor. Partners are not considered employees of the business. Because of this, partners are not eligible for employment insurance if the business fails. Advantages. There are three main advantages to forming a partnership. A partnership allows two or more people to work together and bring different skills and resources to the business. A partnership is fairly easy to establish. The actual registration of a partnership is not expensive or complicated. However, it's a good idea to decide how the partnership will be run and put it into a partnership agreement. And if the partnership suffers a loss, but the partners have other employment income, the loss can be used to reduce their taxable income, thereby lowering the income tax payable by the partner. Disadvantages. There are also disadvantages to forming a partnership. These include the partners are personally responsible for liabilities of the partnership because the partnership is not considered to be separate from its owners. If the business fails, the partners will be personally responsible to pay all the debts and obligations of the partnership. Each partner is personally responsible for the actions of the other partners, because each partner is an agent for the business and for the other partners. Consequently, if one of the partners makes a bad business decision or acts negligently, which results in the partnership owing a debt, all the other partners are personally responsible to pay it back. Also, the resolution of disagreements among partners is generally covered under a partnership agreement or case law. It can be very difficult. There is no act that exists which sets out rules for settling partnership disputes. If the disagreements are not resolved by the partners themselves, they will usually have to turn to outside help, which can be time-consuming and costly. Overall, partnership accounting is the same as accounting for a proprietorship. However, to accurately detail the investment into the partnership by the various partners, a separate capital account and a separate drawing account would be maintained for each partner. Exercise 5-1. On June the 1st, Arthur Blair and Adam Story, who had been operating competing retail stores, decided to form a partnership by merging their two businesses. Arthur Blair has contributed cash, 30,000, accounts receivable, 50,000, in inventory, 80,000, and accounts payable, 20,000. Adam Story has contributed cash, 10,000, inventory, 60,000, land, 40,000, building, 90,000, and accounts payable, 60,000. Prepare a compound general journal entry to record each partner's investment capital in Blair and Story partnership. Be sure to balance each journal entry and provide suitable explanations.
Now you are going to do journal entry. You understand the question, right?
Yes.
Yeah, two partners are merging together. Then you are going to do the journal and prepare one balance sheet for the company.
So we preparing two capital account for each of them, and then we combine it in the
Yeah.
one capital account for the partnership, right?
Yes, yes, yes. You are going to calculate. And the first one, Arthur Blair.
Yes, it is.
Yeah, you are going to write a journal for him first. He's contributed cash, account receivable, inventory, and accounts payable. From that, you are going to calculate the capital. The same way you are going to do for the second one. You have the worksheet with you, right?
Yes.
Yeah.
Right.
Yeah.
Should we count all numbers, or can I write this separately?
Pardon me?
You know, you count after you write like 4,000 cash. Can
Yeah.
I write the separately? For example,
Oh, no. That one is that one. No. That one is balance sheet. By mistake,
okay.
yeah. That one is I brought it. No, you have to first. You have to write the journal separately. That one is the
Okay.
balance sheet. By mistake, I opened that one. Yeah.
Okay.
You are going to do separate journal entry and calculate the capital.
Yeah. Okay.
That is the first entry.
Mm-hmm. Thank you.
After you finish the journal, that is the last step. By mistake, I opened that.
Oh, okay,
The
no
balance
problem.
sheet.
Just I want to ask because
Yeah.
of in my country we are always using the separately for everything, and
Yes,
if
separate
need
journal. Yeah.
yeah, if need to some information, I want to back other years, last
Yeah.
years, I need to know which partnership came to some money or something, right?
Yeah. First, you have to calculate how much he's bringing as a
Mm-hmm.
capital. Then the other one. Then you are going to merge together. The balance sheet is going to be merged together. Calculate the capital. When you calculate all the assets, then the minus, that is your capital, right? Did you calculate your capital, the first one?
Not yet.
140.
How much?
I got 140 because I I did minus $20, 20,000.
Yes. Yeah. 160 million. Yes. Good. The same way you are going to do for the next part.
Oh, the same is for Adam's story.
Yeah,
Yes, the capital Arthur.
yeah. They are bringing equal capital.
But we can see from the balance that the second partner is more
Assets.
successful, yeah, because the
But
amount of money he is
yeah,
operating more.
but he's bringing the payable also. Payable is
Right.
yeah.
But this is
Payable is high.
business.
Yeah. Yes. And from that you are going to create T account and you have the T account also in your sheet, right?
Yes.
Yes.
Yeah. From the T account you are going to prepare the balance sheet. You already finished the journal, then transfer to ledger. From the ledger you are going to create the balance sheet. Then you will know how much cash, how much.
Okay, the balance on the balance sheet is 360.
Oh, you finish it?
Yeah, me too. 360.
Okay. Yeah. This is the way you have to merge. First you have to do the journal, then you have to fill up all the D account, ledger, and bring the, this is the merging balance sheet.
Mm-hmm.
Next exercise. Next exercise is 5-2.
Also, we have two balance sheet. We can use just one, right? We should
No, we
choose.
have to use one because this is the partnership, right?
Yeah.
But
Okay. Yeah.
yeah, we have to use one, but
Mm-hmm.
the capital is going to be separate.
Yes.
Yeah.
Okay.
Yeah.
No,
And
no,
when,
no. Yeah, my page has two balance sheet. Just I want to ask. Thank you.
oh, in your country you are using two balance sheet?
Yeah, I have two balance sheet. I don't know what happened. Okay, it doesn't matter. Maybe it is my mistake. I don't know. Maybe I copy it. I don't have
No,
an idea.
when you are merging, everything has to be in one, right? It's merging now. Yeah.
Yes, it is. Yeah.
But some company like that's a different amalgamating. When they are doing amalgamating, they are having two balance sheet. Yes, that's what I learned. Yeah, two balance sheet. This is merging together. They are going to have one business in one
Yeah.
balance sheet. Yeah.
Mm-hmm.
The next one, 5-2.
Okay.
Do you want to read it? Anybody?
Okay. I am reading.
Okay.
Exercises 5.2. The following transactions are from the records of Campbell and Stewart Co. Record these investment and withdrawals by the partners in General Journal and the post-appropriate entries in their respective capital accounts and derived accounts. It is January 4th. Peter Campbell invested 17,000 cash and computer system worth 8,500.
Okay.
Okay. We should create firstly the
Journal.
bank. Peter Campbell, the 17,000, right?
Yeah. You are going to do compound journal entry, right?
Mm-hmm.
Bank 17,000, computer system 8,500, and the
Yes.
cap. Yeah.
Yes.
Because in this exercise, they are showing how to calculate capital and drawings. That this is only about the capital. Okay, next one.
Okay, January 4th, Brain Stewart invested 4,000 cash and 6,200 in a reversible and Mercedes worth 12,000. Okay, firstly we should use the bank account 4,000 cash for debit. And we should use the receivable, the debit
account receivable.
Account receivable. It is credit, right?
No, both are debit.
No, yes, the both of debit. Yeah. And we should use the merchandise, the credit.
No, merchandise also he brought it. That one
okay.
also asset.
Not credit. Okay.
And those are asset.
Mm-hmm.
From that, you are going to calculate how much capital he brought it. He brought bank balance, account receivable, and merchandise.
Okay.
And from that, how much capital he brought it?
Totally 22,200
Yeah,
credit.
yeah. That is the capital Brian Stewart brought.
Mhm. Okay. The February 10th, Peter Campbell retrieved 500 cash. Okay, bank is credit,
Mm-hmm,
right?
mm-hmm.
And Peter Campbell retrieve is debit 500.
Yeah.
Okay. And Brain Sweetheart Winter 400 and cash and 339 includes tax worth of merchandise for his own use.
Mm-hmm,
Okay, the bank is 400 debit.
mm-hmm.
And okay, we need to calculate. Okay, and HST is 339 debit,
Mm-hmm.
right? And okay, we should
No,
use
he took merchandise from business.
This credit.
Yeah, credit.
Okay.
Merchandise he brought, he took from business.
Mm-hmm.
The total amount is going to be the drawings. He took merchandise, he took cash.
Yes.
Yeah, the total amount is going to be drawings. We separated HST, that means the business is merchandise business. The HST means give it to Revenue Canada, right?
Divide to 1.13.
Yeah, yeah.
Okay. April 16. Brain Stewart used 900 of company funds to pay personal debts.
Mm-hmm.
Okay, it is cash, right?
Yeah.
Okay, we should.
Yeah.
Sorry, can I interrupt you for 1 second? Sorry. So for February 20th, right? So is
Yeah.
it 400 plus that amount?
Yeah, 400 cash, and also he took some merchandise.
Okay, because there's a period after 400, right? So I assumed it was 339
Mm-hmm.
plus 61.
No, the total, cash separately 400.
Okay, so there's a period, so there shouldn't be a period there, right? Like if you read the sentence, it says Brian Stewart withdrew 400, period.
Mm-hmm.
So the period should not be there.
Not the period. That one is because of period 00. By mistake, they didn't put the 00.
Okay, thank you.
Sorry about that.
Okay, April 16th. Brain Stewart used 900 of company funds to pay personal debts. Okay, the bank is credit, and we should use the personal account. It should be debit, right?
Yeah, that is the drawings.
Drawings, okay.
Yeah, drawings is going to be debit, bank is going to be credit.
Mm-hmm. Okay. June 21st, Peter Campbell invested additional 12 thousand cash. Brain Swirt retrieve 2,000 cash. Record these in separate transaction. Okay, we should create the for Peter Campbell 12,000 cash for bank, right? It is debit.
Debit, yes.
Yeah. And also the same thing with Brain Sweetheart, it will be debit.
Drawings is debit, yeah. Cash
Yeah.
is
Okay. July 4th, Peter Campbell gave his home utility bill fund 150 plus tax 1950 from company funds. Okay. I think it is the bank credit, right? Okay. Plus tax. And I don't know another one.
No, drawings, the total, because that is his expenses, not the business expense. We have to put together as a drawings, and the bank is going to be credit.
Okay.
Yeah.
Okay.
This is not the business expense. This is his expense, right? Then
his home utility. Yes.
Yeah.
We shouldn't create a tax account. Okay.
No. Taxes not belong to business, right?
Yeah.
This tax is personal tax, yeah.
Okay. The August 10th, Brain Swirt invested additional 5,000 cash and track valued 7,500. Okay. It is invested. We should create to debit for Brain Sweetheart 5,000 cash. It is bank, right? Okay, and we should create the track valued. It should be debit.
Debit, yes.
Yeah. I don't know which is the credit.
Well, capital is increasing.
Credit is also capital, yes.
A capital, okay.
Yeah.
Okay. The October 1st, the two partners retrieve 1,000 each. Okay. We should create the two bank account. They should be 1,000 plus 1,000. Those are debit, right?
Debit is you have to put individually because different partners, right?
Yes.
Yeah, 1,000 for each partner.
Okay.
That is the drawings account.
Yes.
And bank is going to be, you can put the total.
Okay. Bank is okay.
Bank is 2,000 and because we are going to calculate each capital on the drawings together, yeah.
Okay.
Now you're going to fill up T account and calculate how much is the capital now after the drawings.
Dividing the net income, right? Okay.
Not the net income. We are going to calculate the capital according to investment and also the drawings. This is, you don't have any revenue expenses, only capital and drawings are here, right?
Yeah.
You are going to post in the ledger, the city account, and then from the total, you are going to calculate the capital. Drawings minus, no, capital minus drawings, that's the new capital, right? Yeah. Bank is going to be from the first journal, $17,000. Computer system, 8,500. And capital for Peter Campbell. Capital for Kampa. That one is this.
Мама, мне на буксе.
Yeah, I think I am ready to compare. What do you
Okay.
guys?
Okay. Oh,
Yes.
Yeah, I forget the just 1,000 cash. The which
Oh.
one is October
Yeah.
1st? Yeah. Okay. I have
Just
that.
1,000 cash.
Yeah. Okay.
After everybody finish, we can go to the next one.
Yeah. Also, I wrote 2 times. Okay, I get it right now.
Which
Yeah.
one? Okay.
Just Capital Campbell. I wrote the T account just 2 times. Okay, I got it right now. Okay.
Okay.
Okay, right now I am comparing. The capital sweetheart is correct. Just a Capital Campbell. I have just 1,000. Okay, this one.
Yeah, at the beginning, I was trying to decrease the capital instead of write down, decrease the drawings. But then it was clear.
Decrease the capital?
Yeah, withdraw means decrease the capital. That's why I used, instead of use it separately, I just at the beginning write
okay.
it,
Okay.
which is the same, but
But
we have to
result,
follow rules.
Yeah, the result is going to be same, but we have to have the ledger, individual transactions, right?
Yeah, this manual bookkeeping, it's so interesting. I just can't imagine how people did it before Excel or before SAP.
Yeah, I started with manual accounting. When I started, as soon as I finished my university, I got a job. At the time, everything is manual.
That's good because you see, you know, you can feel the nature. I work 5 years, but I never tried manual account. Now we can see
Yeah,
that.
because your time computer is very common. In my time, when I start, no computer in my country. Even when I come to Canada also, at the time also, only the government and banks, they have computers in the city. I didn't work in the city, but there was no computer.
Yeah.
Now everybody have computer
Yes.
in my country. Yeah. Okay. Now we are going to do. Oh, at the time, in the accounting department, almost 50 people, like a classroom. Everybody has the same different activities. Some people they are doing only the journal. Some people posting the ledger. Some people calculate financial statement, something like that. One
Yeah.
person is writing only checks. One person is after she finishes the check, he has to fill up the cash book, daily cash book. That kind of job.
Yeah, in my country, the same thing. Those are separate.
Now, one person can do everything. Only the journal you have to do it in the system generate everything. Okay, now we are going to do 54, page 54.
Okay.
And that is dividing the net income for the partners.
Are you not tired from my reading? I can continue.
Sure.
Remember that partners are owners of the business, not employees, and as such, may divide their net income as they choose. The partnership contract, however, must state how the net income or loss is to be divided. If there is no contract, the law states that profits and losses will be divided equally. The method chosen by the partners for dividing the profits or losses are called the profit-loss ratio. May be divided equally or may be distributed on a fractional basis, may be distributed based on amounts invested, may be distributed using a fixed ratio, may be distributed using a salary allowance with any remaining profits divided or using a ratio. Example, revenues were 96,000 and expenses were 60,000, leaving 36,000 net income to be distributed to the three partners' capital accounts. Once the amount to be allocated is determined, a closing entry crediting the capital accounts is required. If net income is to be divided equally, the income summary account is closed to the capital accounts as follows. Dividend net income based on amounts invested. The partners may agree to divide net income using a fraction determined by using the amounts of the original capital investment. The following shows the steps involved in this calculation. The first step, determine the amounts originally invested. First partners are 50,000, second partner Loretta 30,000, Abdullah 40,000, total 120. Determine fractions. The denominator is the total amount invested, and each partner's individual investment becomes a numerator.
You know how to calculate the ratio, right? That is the fraction basis.
Well, yes, it should be just 50,000 divided by 120,000.
Yeah, multiply by 36,000. If you want to calculate the ratio also, you can calculate the ratio for three people. Actually, the ratio is going to be 5:3:4 because everything is 0. It's easy to calculate, right?
Yes.
Total is 12. The ratio is 5:3:4.
534, yes.
Yeah. And that is the way the ratio divided by allocate. This is some people they are doing according to ratio. Some people they are doing according to how the contract was divided equally or whatever. That's what they're asking you.
Well, yes, I find this topic is really easy. We cannot stop on this. If our students agree.
Next one, dividing. This is the explanation, examples. Now we are going to do the exercise.
Okay.
Page 55, the exercise.
Okay.
LeMay company reports net income 72,000 for the year ended May 31st of 2018. The partnership agreement specifies salary allowance of 30,000 for LE and 24,000 for BMA. Okay, let's use a calculator.
Do you want to read the first one also in the partnership agreement, the contract may?
Yes, sure. In the partnership agreement, the contract may specify a fixed ratio to be used to divide the profits or losses. For example, say Loretta and Abdullah decided to use a ratio 3:1, respectively. To use this ratio, convert the ratio into a fraction and multiply it by the net income or loss of the period. The steps of using the ratio to divide the profits are as follows. First, determine the fraction from the ratio. Add 3, 2, and 1, you get 6. Thus, 6 becomes the denominator of the fraction. The numerators are the numbers in the ratio, 3:1. We get 3 divided by 6, or a half, 2 divided by 6, or a third, and 1 divided by 6 for
That's
Abdullah.
the way they are going to, yeah. Next, now you can go to the exercise.
Okay.
LeMay company.
Yeah, LeMay company reports net income 72,000 for the year ended May 31st of 2018. The partnership agreement specifies the first salary allowance of 30,000 for LE and 24,000 for BMA. So it's 54,000 salary, and we have to minus it from 72,000 of the net income.
Mm-hmm.
The difference is 18,000, and now we have to divide this 18,000 by ratio.
Mm-hmm.
Interest allowance of 4% based on average capital account balances. Interest allowance of 4% based on average capital account balances. I don't know what this mean. What does it mean? Interest allowance of 4%.
Me too. I don't understand. Yeah.
Because according to the investment, they are getting interest also, 4% interest from the business. Yeah. It's going
Each business?
No, this business.
Okay. Okay.
And
you're going to do the calculation. I think you have this Excel worksheet also, right? Otherwise,
Yes.
you can, yeah.
Yes, you can see 7,200,000. You can add salary 30,000 and 24,000.
Yeah, you are going
I
to
think so. Yeah.
distribute for those two people.
Right.
The total salary is this. Now you are going to see the balance.
Remaining income is 18,000 because
18,000.
it's 72 minus 44.
Yeah.
54.
Yeah.
But then where did you get this number? 40,000 for Lee and 30,000 for RMA?
40,000. They said somewhere else.
Oh, it's below. Okay, so we have to read first. We have to read.
Yeah.
And then go. Okay. Interest allowance of 4% based on average capital account balances. Sharon and reminder on a 60-40 basis, 60 to Lee and 40 to May. Average capital account balances for the year were 40 for Lee and 30,000 for May. Prepare a schedule dividing the net income between the two partners and prepare the closing entry for net income.
Mm-hmm. You are going to prepare the schedule.
Okay.
Yeah, that is the schedule I am showing now. You can prepare the schedule. Net income is 72,000. This is for lead. This is, remember, are you preparing the schedule at the end of the year for depreciation, this kind of partners profit in your experience? Did you?
No, I haven't got this
Okay.
experience.
Yeah. We have to prepare the schedule for depreciation at the end of the year and also the profit distribution. Those kind of things you have to do it in Excel. Yeah. Especially for the auditors. Auditors, they're asking for the schedule.
Okay.
Now, net income is 72,000. One column for leave, one column for May. Salary allowances, you put that one, and the total, the balance is now 18,000.
Mm-hmm.
Now, interest allowance.
4%.
For leave, for 40,000 multiply 4%, that is 16,000. For May, this is the one. Your total is going to be this.
Mm.
After you give this interest,
Okay.
the rest is 15,200.
Okay. 1 and also
Then you are going to calculate the profit
ratio.
Yeah, ratio. Yeah.
Leave, you get 9,120.
Mm-hmm.
And May 6,080. And the total division of net income, it's 40,720. Yes.
I'm sorry, I missed the Lee and my 5,200. How can I calculate that one?
Which one?
That the A13 and A15, the 50, 100, 2,000. How can I calculate that
From
number?
18,000, the balance after they pay the salary, right? This is the salary they paid, 54,000. After that, the balance is 18,000.
Okay.
72 minus 54,000 is 18,000. From 18,000, after they pay the interest, the balance is going to be 15,200.
Okay, each other, right?
Yeah.
Okay.
Just the rest what we have from the initial 72,000.
Yeah.
Just the rest what we have to divide only the rest what we have in the end.
Yeah.
Okay. Mm. Mhm.
This is the journal for income summary account. Income summary is 72,000.
Mhm.
That 72,000 you're distributing for capital, 40,000 in this one, right? Each person how much is getting. The last question is prepare the closing entry for the net income. That is this. This is the net income 72,000. When we are closing, it's going to be the debit side. That one is credit side is capital. According to this, you are going to distribute this one to each partners. You understand now how to.
Okay, I have a question. I don't calculate the total division of net income. Should I count Lee and May division of net income, or should I count just total income?
You have to calculate separately, individually.
Okay.
Because of the individually you are transferring to each capital, each partners, they have different account for the capital,
Mm-hmm.
right? In that case, you have to know how much is each partner is getting, increasing the capital.
Okay.
Only this part is different from proprietors business to partnership. The profit and loss, distributing the profit and loss, and the capital account always has to be separate.
Okay.
I think in page 56 you have a worksheet also, if you want to do it manually. Yeah.
Which one?
The
No,
next page. 60.
Yeah, next page you have the worksheet. Yeah.
Okay. Okay.
What can we move further?
Yeah.
Yeah, for sure. I finished.
Okay. 5-4. The post-closing trial balances of two proprietors on January 1st.
Mhm.
We can see then two companies, Dominic and Silva, decide to form a partnership on January 1st, 2018, and agree on the following valuations for the non-cash assets that they are each contributing. Then we can see the table with assets. All cash will be transferred to the partnership. The partnership will also assume all the liabilities of the two proprietors. It's also agreed that the Silva will invest 10,500 cash.
Do you understand the second table? Dominic and Silva, that one is different information. Dominic and Silva decided to form partnership on January 1st, 2018 and agree on the following valuation. This one is actually in the trial balance that they gave earlier, the balance sheet. That one is a different value, and also they are changing the value in the second table. Yeah. When you are preparing the journal entry, instead of that, you have to use some of the value from here. Yeah. Prepare the separate journal entries to record the transfer to each partner's assets and liabilities and the partnership January 1st, 2018. When you are doing the journal, some of the account receivables for Dominic, 17,500, that one is correct. And 3,500 allowance for doubtful account. Here is 3,000. You have to pick up these amounts. Instead of this, you are going to pick up these amounts. You understand that?
Yes, we just they agree that we have to change
Change the
in
fair
the
value.
trial balance. Yes.
Yeah, this is the book. This is their book value. The second table is the fair value. We are going to merge as a fair value.
How can the Dominic company contribute more than they have in the trial balance? Can you see allowance for doubtful accounts? In trial balance is in 3,000, but in they agreed to contribute 3,500.
Yeah, 3,500 because this one is allowance for doubtful account. That one is they're assuming, right? Not exactly how much. They are assuming this percentage is not going to be get from the customers, right? That now they are giving the fair value. This is the cost. They are giving the fair value 3,500. This is the allowance for doubtful account. According to the previous years, they are assuming this much money we are not going to get from the customers, right? That is the according to the trial balance, they put 3,000, but they are giving different amount, different value, 3,500. You have to pick up the second table, some of the values.
Okay, but should we put minus 500 in the trial balance?
No. Trial balance is their trial balance. This is their company trial balance. Now when they are merging, they are giving different values. Yeah, then you have to pick up the different the second table value for some.
We will just write down the different values without any connection with the previous trial balance.
Yeah.
Okay. Capital one, this one. Okay. Okay. Mm,
Matilda,
Yeah.
I'm on the step of accumulated amortization.
Mm-hmm.
So I have read the notice that when merging the companies as a partnership, the assets are carried at fair value instead of cost.
Yeah.
But I don't have the number of years that were equipment, for example, that were used.
Yeah.
For how
Useful
many?
life. Yeah. How many years they used, right?
Right.
That one, I think they will give that one in the instructions, but in this trial balance, they didn't give anything.
Okay. Then we think that the equipment was just bought.
Yeah. Yeah. For the fair value. From this, you are going to do the depreciation according to how many years you can use. They will give the years, how many years they use, how many years you can use. That one in the partnership, in the agreement, they will write everything. This is just they give the trial balance.
Okay.
When they are merging, they have to have a legal documents, right? Agreement and everything. In that case, they will give the information about the equipments, fixed assets.
Do you think we have to divide accumulated amortization that we have in trial balance according to the part of equipment that was merged? For example, Dominique company has equipment for 45,000,
Mm-hmm.
but they only merge 23,000.
Mm-hmm.
Do you think we have to divide 23,000 to 45 and then use this ratio in accumulated amortization equipment, because amortization should be in the same part that equipment.
Mm-hmm. That one is, if you, according to this, you can calculate how many years they used,
Right.
right? But in the trial balance, they have that, but they will give all the information in the agreement. When you are taking the agreement, you will have all the information about how many years they used, how many years they can use more, something like that. How many years the useful life, the balance also. But if you want, you can calculate that way in the real life. When you are merging,
Mm-hmm.
but this is just assignment, they are giving this. Instead of giving the cost, they are giving according to the fair value.
Yes.
Okay.
This one is 45 minus 24, 23. Mm.
I have a 10,000 different for balance sheet. I don't know.
Balance sheet
I
is
miss.
different.
I miss. Yeah. I miss something. Can you open the? Yeah, that one. Okay. Yeah, it is. Yeah. Okay. Okay, I see. It's correct. Yeah. Okay.
Can you read?
Okay. Yeah, I can read. I can read. Okay.
It's small letters. That's what I'm asking.
No, that's okay. That's okay. Just I'm checking the numbers. That's also okay.
Matilda,
Yeah.
why is the bank on the credit side?
Bank in the credit side.
Yeah, the 36,500.
And this is not in the credit side. There are two columns.
Okay, that's a total. Okay, okay.
Yeah, two columns. Remember I talk about the fixed assets. They always have two columns. One
Okay.
column is showing the cost and the depreciation. The same way this account, original account receivable is 43,500. They have doubtful account. That's what the outer column is showing the difference between those two. You understand, Mohammed?
Yeah.
Yeah. And this is the way you
Okay.
are going for the depreciation also. You are going to have two columns. The inner column is going to show the cost and the depreciation. The outer column is going to show the book value. Depends on how the format is. This is the format is showing. Outer column is going to show all the book value. Inner column is going to show the calculations.
How did you calculate it? 37 for account receivable. I
This is
didn't found that.
this is account receivable. This is doubtful account, right? Allowed
Okay, okay, I got it. Okay.
This minus this is this. Yeah.
Okay. Yeah, okay. Okay, I got it right now. Okay. Okay. Can you go to a little bit down, please?
Okay.
Okay. Okay, I got it. Okay. Thank you.
Thank you. After you finish, we can go to the next exercise.
Okay, I'm reading. Liquidation of a partnership. The liquidation of a partnership ends the business. It involves selling the assets of the business, paying liabilities, and distributing any remaining assets of the partners. Liquidation may result from the sale of the business by mutual agreement of the partners or from bankruptcy. A partnership liquidation ends both the legal and the economic life of the entity. Before the liquidation process begins, the accounting cycle for the partnership must be completed for the final operating period. This includes the preparation of the adjusting entries at trial balance, financial statements, closing entries, and post-closing trial balance. Only balance sheet accounts should be opened when the liquidation process begins. In liquidation, the sale of non-cash assets for cash in called realization. Any difference between the net book value and the cash proceeds, it is called the gain or loss on realization. Capital deficiency. A capital deficiency may be caused by recurring net losses, excessive derives, or from the realization during liquidation. Okay, exercises 5-5. S. Anderson, J. Hinton, and R. Amistad divulged their partnership as of August 31st, 2018. Before liquidation, the three partners shared income and losses in the ratio of 3-4.
3:2, yeah.
Okay. After the books were closed on August 31st, the following summary accounts remained. Okay. The cash is 6,000. Non-cash assets is 110,000. Accounts payable is 25,000. S. Anderson capital is 30,000. J. Harrington capital is 20,000. R. Amistad capital is 41,000. Right?
Yeah.
Okay.
On September 24th, the questions are in the bottom, yeah.
Okay. On September 24th, the partnership sold the remaining non-cash assets for 74,000 and paid the liabilities.
Non-cash assets is 110,000 according to their balance sheet, but they sold for 74,000, right?
Yes.
Yeah. And paid the liabilities. Mm-hmm.
Okay. If there is a capital deficiency, none of the partners will be able to pay it. Okay. Prepare the journal entries to record. First is the sales non-cash assets. Second is the allocation of any gain or loss on realizations. Third is the payments of liabilities. Fourth is the distribution of cash to the partners.
Yeah.
Okay.
The first we are going to prepare the sales non-cash asset. That means non-cash assets 110,000 and they sold for 74,000. That is the journal you are going to do it first.
Okay. Actually, I don't have any idea right now.
Okay. Because because non-cash assets is 110,000. That is in the debit side, right?
Yes.
Yeah.
Then they are selling for $74,000. That means they are receiving cash $74,000. The rest is going to be, you already read it about realization, right?
Mm-hmm. Losses of realization, the rest
Yeah.
should be.
Yeah, the rest is going to be like
Okay.
that. They got the money.
Okay, Anderson.
The cash is only 74,000. Lots of realization is 36,000. The non-cash assets is going to be 110,000. Because when you are selling, that one is going to be in the credit side, right?
Mm-hmm.
It was in the debit
Yes.
side. Yeah, they are receiving only 74,000. The 36,000 is going to be they are lost.
Then they pay liabilities, 25,000.
Yeah. Allocation of, no, the second one is the allocation of any gain or loss on realization. That is the second question. The realization is in the debit side. That one is going to be in the credit side. You are going to allocate for 3 people. How much is, they give the ratio also, right? 3:2:4. This is the total. That one is debit. Here is the debit side. When you are distributing to partners, that one is going to be in the credit side. You are closing this, right? The loss of realization account also you are closing. That's what you are going to put in the credit side. And the debit side is going to be partners.
Mm-hmm.
You are going to distribute for 3 partners. How much you are going to do it. That is the second one, allocation for any gain or loss on realization. If you get profit, that one, this one is going to be in the other side. If you sell for more money than your book, that one is going to be your profit. That one is going to be increase their capital. This one is decreasing their capital. Then you are going to calculate how much is the realization is distributing to each partners.
Okay, it's 12,000 for Anderson.
Mm-hmm. Yes.
Then 8,000 for, not 8, wait, 8. 8,000 for
Hinton.
Hinton, yes. And the rest, 16 is for the next partner.
Yeah. The third question is payment of liabilities. Their liabilities $25,000.
And they have cash 74.
74. Yeah. They are going to pay liabilities. And when you are paying, cash is going to be credit, accounts payable is going to be debit, right?
Right. And finally, distribution of cash to the partners.
Yeah, that is the last part. Whatever they have, the rest they are going to distribute to partners.
Okay, the distribution ratio is the same,
Yeah, same.
and the sum for distributing is $49. $49,000.
Yeah.
Oh, why do you have 55?
74 minus 25.
74 minus 25.
Yeah. We have bank 74, right?
Yes, but it's
Yes.
supposed to be 49.
74 minus 25. Oh, we have
6,000. What is 6,000? Oh, cash. They have
cash,
initially
yeah.
cash.
Yeah, they have cash too.
Right.
6,000 cash also they have it. That's what I prepared the trial balance first. Okay. Now you understand how to do the liquidation, right? We learned not deeply about the partnership, but we learned the basic informations, how to merge, how to prepare the trial balance, how to distribute profit or loss, those kind of things. I think you learn more than this in your past lesson, right?
Yeah, it is. But actually, I have a question. I don't understand. Also, I'm missing the that part. How we can calculate 36,000 for each partners? I'm sorry about that. I don't understand.
Which one are you asking about?
Okay, the about column C 24. Each partner has a 36,000, right?
Okay.
Sorry
According to
about
the
that. I
ratio-
missed that.
No. According to the ratio is 3:2:4, right?
Yes.
3:2:4 means 3 plus 2 plus 4, 9. Then you are going to divide 36,000 divided by 9 and multiply by 3 for Anderson, multiply by 2 for Hinton, and multiply by 4 for the other partner.
Okay. And what about 36,000? How we can calculate that one?
36,000. See,
Okay. Gross rate.
from
Okay.
110,000 is the total non-cash assets according to their trial balance, but they sold only for 74,000. The loss is 36,000. The realization is 36,000.
Okay. I need to minus. Okay. I got it right now. Okay.
Yeah.
Thank you.
That 36,000 partners are taking.
Okay.
Yeah.
I got it. Thank you so much.
You're welcome. In the next class, we are going to do bank reconciliation.
Okay.
We have only 7 minutes, so we can do it in next class. Huh? The bank reconciliation.
Okay, next class this Friday, right?
Friday, this Friday.
Okay. February 12th. Okay.
I will send the invitation.
Yeah, okay. No, just I'm taking some notes about that.
Okay.
Okay.
Thank you so much.
Yeah, thank you so much for everything.
Thank you.
Thank you for the cooperation. Thank you, Mohammed, for your help. Thank you for the cooperation for all students. See you on Friday.
See you. Take care, guys. Bye-bye.
Bye.
Thank you. Bye.
Bye.